Good morning, everyone. Thank you so much for joining us. I'm here today with Ken New. Ken, how are you?
I'm doing well. How are you today, Gina?
Good. We're looking at high heats today in Michigan, up to 100 degrees.
Ooh, yeah, the century mark.
Yeah. So we're getting a little taste of what Florida's like. So
Yeah, every day down here, not 100, but hot and humid, that's for sure.
yeah, absolutely. So Ken, it seems like it's been a tough time lately for investors in U.S. stocks lately. So we're here today to talk about market volatility.
Yeah.
So you want to just kind of elaborate about market volatility and
Yeah, absolutely. First of all, it's always expected to have fluctuations in the market. And when they get extreme, we begin to call it volatility because the numbers get big and then we get concerned and then it seems to move in one direction or the other. Of course, we always love it when the market's going up. So we don't really question that kind of volatility to the upside. We're always thinking of volatility being to the downside. Okay, or we're losing and the market's moving in the wrong direction. So let's talk a little bit about, what makes that happen? I mean, why is this going on? Because I think it's important for investors of all kinds to be able to look at reality as it starts to play out. And here's our reality. We have a monetary policy that has been highly manipulated for many administrations and a couple decades now. We can go back to the early 2000s, and Alan Greenspan did rate price increases and decreases to manipulate the markets and so on. That's called monetary policy. Now, as of late, we have a monetary policy that has driven rates down to zero. All right. And we printed trillions of dollars to create stimulus, which, as it turns out, is a little bit of an overkill for the pandemic response.
Yeah.
And so the pandemic was created, and here we've got this huge issue, which very necessary for it to be addressed and so on. Now, as it turns out, the trillions that were printed really created a false prosperity, if you will. It just created a scenario to where, okay, there's plenty of money out there, there's plenty of liquidity, and so on and so forth. But what does that create? The more money that's created, if you think about it, if you have $100 and then you double it to $200 and everybody has $200, does that mean everybody's richer by another $100? Well, not necessarily. Okay, it is for a while until we realize there's a lot of money floating around out there buying too few goods. Okay, so the point of it is it creates inflation. That's basic economics. All right, and this is the play out of the basic economics. You can go back to what you think is reality, and it's starting to play out. You put a lot of money out in the marketplace, and it creates less value for each one of those dollars out there. Now, what has happened with that is the Fed, okay, or the central banks all around the world, not just in the United States. We focus on our guys here, Jerome Powell and so on. But now they need to consider rate increases. And so we've had all this prosperity and all this free and easy liquidity and so on for many, many years. And now all of a sudden, there's this threat of rate increases.
Yep.
All right. So markets don't like uncertainty. And we have uncertainty. And that creates volatility. And now we're in that scenario, and it will continue to play out until we see some semblance of a top, okay, or some semblance of stability there. We don't have that yet. We have high inflation. In fact, we have record high inflation, and that's freaking people out. All right. Now that puts a strain on things like corporate profits. That comes into question now. Okay, and it's coming into question because can the consumer still spend? And even prior to that, are the corporations, is middle American companies, and even the larger companies, are they going to be able to spend, therefore get that money into the economy and create the velocity that's necessary? So that gives you, that kind of frames that part of that conversation a little bit. And my side note to that is, can you imagine what would have happened when this new administration got into office and they did pass that $6 trillion stimulus package that was proposed? I mean, off the charts numbers would be happening at this point.
Yes, most definitely.
So that's what fuels volatility. I mean, that's a part of the engine. There's even more to it, but that's a good way to be thinking about this volatility.
So can you just kind of talk more into the big swings in prices? Why the big swings in prices?
Well, first of all, you see a lot of evidence out there that their supply chain, that's a lot in the news. And so I'll comment for just a moment about that. I mean, lots of stuff hit the headlines.
Yeah.
And, we buy into it. One of the famous examples is toilet paper. We're not that far away from toilet paper, but everybody was hoarding toilet paper like it was a valuable asset. So
Ken, really, I never understood toilet paper when the stocks were fully stocked of hand soap. So I don't know. During the pandemic, I would think people would be more concerned about washing their hands. But
yeah, and so that suggests that there's a lot of headline news out there. Suggests there's a lot of emotion out there. And when you're dealing with the markets, now I've always found that to be interesting because we think of the markets and there's a lot of markets. There's the bond market, there's the equity market, there's the debt markets, there's commodity markets, futures. So there's so much out there that we could be talking about, but I think we normally identify with the S&P 500 index or the Dow Jones Industrials as kind of this barometer for what the markets are doing. And they're going to move based on headlines, and it's not really logical in many, many cases. So there's a little tidbit for that.
So what should our response to the markets be right now? How can we protect our money?
Well, here's the thing is, first of all, each investor needs to talk to where they get the advice from, whether it be from a professional, whether it be from the neighbor, a brother, their CPA, whomever it may be.
Yeah.
But it gets back to the basics. Know what you want to invest in. Quality, as an example. Who are you as an investor? That's really a great question to ask. So as an example, if you're a retiree needing income and you're looking for growth to help offset that need for income in the future because of inflation, that's a certain set of circumstances. If you're a retiree or a pre-retiree, I mean to say, with the same kinds of goals, future income, future growth, there's a certain set of investment principles that would be very helpful for that. If you're a young person, if you're just starting out, you're in your 30s or 40s, then the volatility should be, minimal, in terms of the way that you look at the market. And the first thing I would say is own very quality assets that are designed to meet your number one need.
Right.
Now, that's very different for someone who's retired needing income and someone who doesn't need income, they need growth. What are the differences? Well, income is right now. I need cash flow right now. So we want dividend paying assets. We want to be able to put together a portfolio that's going to pay us every month. They call it mailbox money. Okay. It's just money is coming in every month and you pay your bills with it. It creates your lifestyle in retirement. That can come from the public markets. And in many cases, I advise looking at the private markets for that type of solution.
Yeah.
Why? Because now you don't have the fluctuation up and down of that principle. So you don't have that distraction of what's going on. And you get paid typically a higher dividend or a higher interest rate on a private type investment. I'm talking about private equity or private debt. Those are very good solutions for investors who are looking for income now. And so there's a helpful hint on that side of things. Thinking about, is my primary need and does the investment meet that? Because look, if your stocks are going up in value and you're needing income, then that growth really isn't helping you. It's the cash flow. So you'd have to sell them in order to get it anyway. So there's a couple of thought processes that I use typically with identify with what your need is as an investor, and then the market and that volatility really isn't going to be your concern.
And this is why it's so important to see, a professional financial advisor for help, because I wouldn't know anything like that. So this is why you come and play and why you are so important.
Well, as a side note on that really is that when the investment is put into place and you're looking for that growth and you see the volatility, then you see that your investment is not working properly. Okay, it's not growing properly. And we have to recognize from at least some level, we have to recognize that putting money in the market with the expectation that it's going to just go up is not very realistic. It's a hope. That is not the plan. It is a hope that it goes up. So you want to take a look at those assets. As an example, if you just go all in with the S&P 500, well, that's more of a hope than a plan. Mm-hmm. Now, if you were to go in and say, okay, I want to have an investment in Tesla or Walmart or Berkshire Hathaway or Google. And so then you say, okay, well, now I'm centered in tech stocks that are big companies. Apple as an example. These are companies that will have volatility, but over the long haul, they're moving in the right direction. So you ride out that volatility versus the S&P 500 that's going to create volatility because there's so much buying and selling that are going on day to day without really the mindfulness of knowing that holding that asset over time may be your best strategy.
So Ken, what is diversification and investing? Can you just tell us a little more about that?
Yeah, it's a great question. And what it gets down to in large measure, you're thinking about stocks or you're thinking about bonds, or in other words, equities and debt. And so inside of equities, it could be many different things. In the private equity side, as an example, we're looking really to invest in whether it be businesses or in real estate deals. But we want to get specific about that. We may want to be into equity deals that focus on energy because of the need for energy. And there are different sponsors out there that make that happen, both in the private side as well as the public side. And so it's in many cases taking a look at those investment strategies that align themselves with what is actually happening. I mean, we've got kind of a changing world order. You've got work from home. So, a lot of businesses aren't going to go back to business as usual. You've had a tremendous run up in real estate prices. So you look at that and you say, well, people are coming in right now. Should I get out of the real estate market because the real estate market is crashing? Well, not necessarily crashing. There's still great opportunities there. What real estate market are we talking about? Are we talking about housing and I don't mean any denigration of this, in Kansas or Omaha, Nebraska? That might be a whole different dynamic than housing in Central Florida or housing in Charlotte, North Carolina or Nashville, Tennessee. These places are booming.
Yes, especially Florida. Yeah.
Absolutely. And so we really want to get specific and do our due diligence on that investment. So number one, invest in quality assets. Know what you're investing in. Don't lose sight of your goals. What are your objectives? What are you trying to accomplish? Is it income? Is it growth? If I'm invested in the market for growth and you're just in an index, then that's not very specific. That's general, better than not in some but when the market's going up, you don't even think about it. But when the market's volatile, now it's like, oh, geez, this plan isn't working. So get specific and address the priorities. The main thing is that try to not have the anxiety that's associated with that. Don't panic with it. Know your asset. If it's a good company in a good sector, growing, then recognize what the risks are and then minimize those and hold your asset. Really, buy and hold is still the very best strategy overall, as long as you have quality assets. So in other words, stay with your financial plan. Your
Yes.
original plan, if it's a good plan, stick with it. Don't check your accounts every day to legitimize your investment or any of that. That's not important. You're gonna have ups and downs every day. So you're not gonna, rejoice when you're having an up day, and you're not going to be depressed when you're having a down day. It's going to go through all of those, and over time, you're looking for that movement in the right direction.
And we were just talking right before we went live about the markets going up and down, and how fearful people are getting, and their anxiety is just skyrocketed. And you had such a great explanation about, all of that. I don't know if you want to share just a tidbit with everyone. It was just very informative.
Yeah, the thing is that everyone wants to stop, and what new investment should I get into that is going to offset inflation or offset the current mitigation that we have. And so the story today is about inflation. And it may be tomorrow about corporate earnings, and it may be about the consumer spending. And there's always going to be something going on out there that gets our attention, that makes us think that our investments are or are not what we expect for them to do. Number one, I think each investment should be spinning off some profits to the investor on a monthly or a quarterly basis, whether it be stated income. Because look, if you don't need the income, you can reinvest it, and that becomes your growth then. So I always prefer an investor be somewhat allocated to the private markets, because now we don't have to worry about public sentiment. We don't have to worry about public policy, the tweet of the day. Sometimes you get all this noise that's going on out there. And the best thing you can do is just block it all out and know that you've got a forward-looking plan, but diversify with that equity, with real estate and debt. And specifically in debt, think about the floating rate strategy, meaning that these are the kinds of debt instruments that go up as interest rates rise. No question the interest rates are going to rise. We just don't know how far. And how far-reaching it is. And inflation will help dictate that, because the Fed's way behind the curve at this point. They are just reacting and grasping for a solution to try to keep that inflation down. And that's going to drive the ship right now. That's going to drive the policy. And it shouldn't. It should be, we're going to stay with our thesis and move with equities that are performing well. And creating profits and stability, move with real estate projects that are still solid, and they're a hard asset. It's not going away. The demographics aren't going to change. People are still going to need the housing of a variety of kinds. So diversifying within that industry, and then going with good debt structures, and especially looking at anything that is floating rate, so that you can not be caught with a long duration debt at lower rates.
So those are great investment goals, really, to kind of focus on if we can avoid volatility. And like you said, stick with your financial plan, seek financial help, professional help. Don't wing it, right? We can't do this on our own. At this point, yeah.
Get some help with the due diligence.
Yes.
Get a professional perspective, or do your due diligence. Ask the right questions. Find out those questions that are necessary in order to validate what you think might make a lot of sense in an investment strategy, and then talk to someone who has some knowledge of that, and they can share that with you. And that's exactly what we do at our practice, is that we are going to have these kinds of discussions with our clients, so that they understand what they own, why they own it. And, the phone is not ringing. People are not concerned about their portfolios right now, because the primary goal of our practice is to protect the principal. Okay. Yeah. Well, you can't do that if you're all in the market, because the market's going to do whatever it does. It doesn't matter how well we look at it day in and day out. This is not day trading. Okay, for some, day trading might be appropriate, but stick with good hard assets that produce the results you're looking for and ride the course.
That was amazing information, Ken. Thank you so much for hopping on and explaining. This is a really scary time for a lot of people. So, I always feel like these little mini Facebook Lives just kind of help ease that anxiety that everyone is feeling right now. And I just feel like you have that approach where people can come up to you and approach you with any questions that they may have, whether they're existing clients or maybe if they want to become, a current new client with you. And coming from my side, you are so helpful with answering all the questions that I have. So I appreciate all of that you do.
Well, I love getting on the calls. Yeah, it's an absolute pleasure to get on here and just be able to wing it and talk about what's going on.
Yeah, absolutely. Well, thank you so much again for joining me, everyone. Anyone watching, if you have any further questions, contact Ken. He's very informative. He will happily answer any concerns or questions you all may be having. Don't forget to comment, like, and share this video. And Ken, until next time.
Thank you so much, Gina. Have a good day today.
Yes,
Bye for now.
Bye.